Picture this. Sarah just got her first real paycheck. After rent and bills, she's got $500 left over. Her friend says, "You should invest." So Sarah downloads a trading app, stares at thousands of stock options, and freezes. Apple, Tesla, Nvidia. She has no idea which companies to pick. One wrong choice, and she could lose everything, right? Then her co-worker Jennifer mentions something called an index fund. Sarah looks it up. Wait, this seems way too simple. What's the catch? Here's what's wild. Index funds are boring, unsexy. They don't promise overnight riches. But over the last 30 years, they've quietly made more people wealthy than any other investment strategy. So why isn't everyone doing this? What's up, everyone? Today we're explaining index funds, the investment strategy so boring it actually works. We'll show you why this beats expensive fund managers, how it's made regular people millionaires, and why it's probably the smartest move for your money. Hit that like button if you want to get rich slowly but surely. Let's start with what an index fund actually is. An index fund owns a little bit of everything in a specific market. The most popular tracks the S&P 500, the 500 biggest companies in America. Buy an S&P 500 index fund and you own tiny pieces of Apple, Microsoft, Amazon, Google, Tesla, and 495 others all at once. Think of it like this. Instead of picking which restaurant will succeed, you buy a tiny piece of every restaurant in town. Some thrive, some fail, but overall, you're betting the restaurant industry grows. Sarah likes this. She doesn't need to become a stock expert. She doesn't have to pick the right companies. She just buys the entire market. This is lesson number 1. Index funds let you own everything, so you never miss the winners. Now here's where it gets interesting. Let's compare index funds to what professional investors do. Meet Marcus. He pays a financial advisor to actively manage his money. Fancy MBA, years of experience, analyzes stocks all day, trying to beat the market. Marcus pays 1% annually for this service. Sounds smart, right? Experts should beat amateurs. Except they don't. Over the past year, only 33% of actively managed funds beat their index counterparts. That means 67% of professional fund managers did worse than buying an index fund and doing nothing. Over 10 years, only about 15% of active managers outperform. Over 20 years, even worse. In 2024, 65% of actively managed large-cap funds underperformed the S&P 500. Professional investors losing to a simple index fund that requires zero skill. This is lesson number 2. Professional fund managers usually lose to index funds, and they charge you for it. Why do index funds win? 3 massive advantages. Advantage number 1. Costs are insanely low. Index funds charge 0.11% per year on average. Active funds charge 0.59%, over 5 times higher. 0.5%? Big deal. Actually, huge deal. Sarah invests $10,000, earns 7% annually for 20 years, at 0.11% fees, $38,170. At 1% fees, $32,070. That's $6,100 lost, 16% of her money gone to fees. Better example, $100,000 invested for 20 years at 4% return. Pay 0.25% fees, $208,000. Pay 1% fees, $179,000. That's $29,000 vanished. Advantage number 2, you own the winners automatically. Nobody knew Apple would dominate in 2005. Amazon looked overvalued in 2010. Nvidia was a niche gaming company 5 years ago. Index funds owned them all automatically. When Nvidia exploded, index investors were already there. When the next surprise winner emerges, they'll own it too. Active managers try to guess winners. They're usually wrong. Index funds don't guess. They own everything. Advantage number 3. Zero effort required. Marcus spends hours researching, checking portfolios, watching CNBC. Sarah bought an index fund and forgot about it. Checks maybe twice a year. Same returns, way less stress. This is lesson number 3. Index funds win through lower costs, automatic diversification, and zero effort. Let's talk numbers. The S&P 500 has averaged about 10% annual returns over 30 years. Adjusted for inflation, 6 to 7% real growth. If Sarah invests $500 monthly in an index fund at 10% annually, 10 years, $102,000, 20 years, $380,000, 30 years, $1.13 million, 40 years, $3.16 million. She invested $240,000 total. The other $2.92 million, compound growth. That's the power of boring, consistent investing. No genius required, just buying and holding. Marcus, paying 1% fees to his advisor, ends up with about 20% less. Hundreds of thousands lost to fees. But what about market crashes? Great question. Markets crash. 2008, 2020, 2022. Brutal years. What happens to index investors during crashes? Accounts go down 30 to 40%. What do smart investors do? Nothing. Keep investing. Why? The market always recovers and hits new highs. The S&P 500 survived the Great Depression, World War II, dot-com crash, 2008 crisis, COVID. In 2008, the S&P crashed 36%. Panic and sell? You locked in losses. Hold on or keep buying. By 2013, you're back to even. By 2015, you're up big. The investors who got rich didn't time the market perfectly. They stayed invested through scary times. This is lesson number 4. Index funds work because you ignore the noise and let time do the work. What does Sarah actually do? Step 1. Open an account. Vanguard, Fidelity, or Schwab. Takes 15 minutes. Step 2. Pick an index fund. Total stock market or S&P 500. VTSAX, FXAIX, VTI, or VOO. Step 3. Automatic investing. $500 monthly, automatically. Set and forget. Step 4. Do nothing. Don't check daily. Don't panic during crashes. Let it compound. 4 steps. Sarah went from newbie to building serious wealth. Here's my take. Index funds are the closest thing to a free lunch in investing. Instant diversification, rock-bottom fees, tax efficiency, historically great returns. You don't need to be smart, lucky, or connected. Just patient and disciplined. Will you get rich overnight? No. Will you have exciting stock stories? No. Will you likely end up wealthier than people trying to be clever? Absolutely. The data is overwhelming. Index funds beat most professionals. They've made regular people millionaires. Zero financial knowledge or time needed. Sarah started with $500, set up automatic investing, and she's building wealth while living her life. No stress, no complexity, no expensive advisors. The boring way isn't sexy. But it works. In 30 years, when Sarah's sitting on over $1 million, she won't care that it was boring. So there it is, index funds explained. Simple, effective, proven. The strategy that wins by being boring. Are you investing in index funds or still picking individual stocks? Drop your strategy in the comments. And if boring is beautiful to you now, hit that subscribe button because we're breaking down every smart money move that builds real wealth. See you in the next one.